Over $1 trillion in U.S. credit card debt is outstanding right now. That number is real, current, and already embedded in the system. It exists at the same time equity markets sit near historic highs. That contrast is not a forecast. It is a condition. Welcome to the Finance Historian. If you're new here, this channel examines markets the way geologists study fault lines, slowly, structurally, and without drama. Let us know where you're watching from. And if this kind of analysis matters to you, press the like button and subscribe. It helps more than the algorithm admits. By the end of this video, you will understand 3 things. What is happening beneath the surface of today's economy? Why this divergence keeps repeating across centuries? And what history shows typically happens next, not as prediction, but as pattern. Pause for a moment on the opening contradiction. Stocks are strong. Indexes are elevated. Corporate earnings, at least on paper, appear resilient. Yet daily life feels expensive. Housing feels out of reach. Food prices feel sticky. Debt feels heavier. This sensation is not psychological. It is structural, and it has happened before. Not once, not twice, but repeatedly, across empires, financial systems, and monetary regimes. To understand why Wall Street can soar while the lived economy strains, we need to step away from headlines and return to cycles. Not political cycles, not election cycles, economic ones. Long duration, mathematically constrained cycles that operate whether participants believe in them or not. These cycles are driven by capital concentration, liquidity distribution, and institutional behavior. They are quiet, they move gradually, and they leave very little evidence while they are forming, which is why most people don't notice them until after the shift has already occurred. Public attention tends to move loudly. Markets, by contrast, move silently, especially when institutions are repositioning, when pension funds rebalance, when insurers adjust duration, when sovereign pools rotate exposure. These actions rarely make front-page news. They don't need to. By the time the public narrative changes, the structural movement is usually complete. This brings us to the core idea of today's discussion. There is a repeatable historical cycle where financial asset prices detach from the economic experience of the majority. Not temporarily, but structurally. This cycle does not depend on greed or fear. It emerges from arithmetic. At its core, the cycle reflects one simple constraint. When liquidity is unevenly distributed, asset prices respond first. Wages respond last. And the gap between them can persist for years, sometimes for a decade. This pattern has appeared under gold standards, fiat systems, colonial trade regimes, industrial revolutions, and digital economies. Different technologies, different currencies, same structure. To make this concrete, we need to define the cycle itself, not as a story, but as a sequence with identifiable stages, each with recognizable behaviors and time frames. Across history, the cycle typically unfolds in 5 broad stages. This stage begins with a shock or slowdown, war, crisis, recession, financial panic. In response, authorities expand liquidity to stabilize the system. Credit becomes cheaper. Balance sheets grow. This stage feels supportive, relief-driven. It often lasts several years. New liquidity does not flow evenly. It moves first toward assets with existing ownership structures. Equities, real estate, bonds, private capital. Institutions absorb liquidity faster than households can. Asset prices rise. The economy stabilizes, but unevenly. This is where the disconnect becomes visible. Markets look strong. Economic confidence surveys recover. But cost of living pressures remain. Debt grows quietly. Savings rates weaken. This stage can persist for a long time, often the longest phase of the cycle. Eventually, limits appear. Not crashes at first, but friction. Credit tightens. Defaults tick up. Consumption slows despite high asset valuations. Narratives begin to fracture. Only at this stage does the cycle resolve. Sometimes through inflation. Sometimes through deflation. Sometimes through financial restructuring. Rarely gently. What matters is not the trigger, but the build-up. Now, none of this is theoretical. We can observe it repeatedly in recorded economic history. In late Roman finance, when land values surged while provincial wages stagnated. In the Dutch Republic, when asset speculation outpaced trade incomes. In Britain during the late stages of the Industrial Revolution. In the United States during the 1920s and again in the late 1990s. Different centuries, Different instruments. Same sequence. What made each period confusing for those living through it was not volatility. It was contradiction. People were told prosperity was visible, but they did not feel it. That dissonance is the signal, not because it predicts collapse, but because it identifies the stage. And today, that signal is widespread. High asset prices alongside rising household leverage. Strong markets alongside fragile consumption. Record valuations alongside affordability strain. This does not mean the system is about to fail. History does not work on emotional timelines. It works on constraints. In the next part, we will begin examining historical case studies where this exact divergence appeared, quietly, gradually, and without immediate consequence. Not to alarm, but to orient. Because once the structure is understood, the confusion fades. And what remains is clarity. A calm recognition that the pattern is already visible and already unfolding. Before examining specific historical cases, we need to slow the frame even further. Because the most common mistake in financial history is assuming that markets reflect economic health in real time. They rarely do. Markets reflect capital positioning. Economies reflect resource distribution. Those two mechanisms move on different clocks. In periods where capital becomes concentrated, markets can appear strong even as economic participation narrows. This is not an anomaly. It is a feature of financial systems once they reach a certain scale. To understand this, consider a basic structural truth. Large pools of capital are not designed to optimize human comfort. They are designed to preserve purchasing power across time. When risk rises in the real economy, job insecurity, price volatility, wage pressure, capital does not retreat. It consolidates. This is where the disconnect begins. Households respond to rising costs by borrowing, delaying consumption, or reducing quality of life. Institutions respond by reallocating toward assets that benefit from scarcity, pricing power, or financial leverage. The two responses are rational. They are simply not aligned. This divergence is easiest to see during long plateaus in equity markets where volatility is low, but strain underneath increases. Historically, these plateaus are misunderstood as stability. In reality, they are periods of absorption of liquidity, absorption of risk, absorption of future demand. Let's look at a concrete example. In the United States during the late 1920s, stock prices rose steadily. Not violently, not irrationally, by the standards of the time. At the same moment, household debt expanded rapidly. Installment credit grew. Wages lagged productivity. New consumer goods, radios, appliances, automobiles, were widely available, but increasingly purchased on credit. This allowed consumption to continue even as purchasing power weakened. Markets interpreted this as growth. The economy, underneath, was borrowing time. The divergence itself did not cause the eventual collapse, but it made the system fragile. This same pattern reappeared decades later. In Japan during the 1980s, asset prices surged. Land values detached from income. Equities reached historic multiples. Every signal on financial dashboards suggested strength. But wages flattened. Household leverage increased. Consumption growth slowed beneath the surface. Again, capital was doing what capital does best, protecting itself by bidding up scarce assets. Again, the lived economy lagged. These examples are not warnings. They are reference points. Because the purpose of history is not to predict timing. It is to identify structure. And structure tells us what can happen, not what must. Now return to the present. Equity markets today are heavily influenced by a narrow concentration of capital-intensive firms. These firms benefit disproportionately from scale, network effects, and financial engineering. Their success lifts indexes. But indexes do not measure distribution. They measure capitalization. This is why market highs can coexist with economic discomfort. Because the market is not voting on how many people are doing well. It is weighing how much capital is positioned in specific places. This distinction matters. It explains why headlines can celebrate gains while surveys reflect stress. Why GDP can grow while real wages stagnate. Why wealth effects feel invisible to those without assets. Now, at this point in the cycle, something else becomes visible. Silence. Institutions rarely announce major transitions. They signal them indirectly. Through duration shifts. Through liquidity preferences. Through portfolio concentration. You won't hear a press conference announcing caution. You'll see it in balance sheets months later. This silence is often mistaken for confidence. In reality, it is preparation. Not preparation for collapse, but for constraint. Because all systems eventually encounter limits. Credit limits, demographic limits, energy limits, productivity limits. When those limits approach, capital begins to favor stability over expansion. And that preference shapes markets long before it shapes headlines. At this stage, public narratives often become confusing. One day, the economy is strong. The next, consumers are strained. Both can be true because they describe different layers of the system. Markets are upstream. Households are downstream. What happens upstream takes time to reach the broader economy. What happens downstream rarely feeds back upward until constraints harden. This is why this phase of the cycle feels disorienting. People are told things are improving, but their budgets say otherwise. History shows that this confusion is not accidental. It is inherent to the structure. In the next part, we will formalize this structure more clearly. We will break the cycle into its distinct stages again, but this time with timelines, with durations, with observable markers that appeared repeatedly across centuries. Not to label the present with certainty, but to locate it with discipline. Because once the stage is identified, the rest of the pattern becomes easier to recognize. And recognition, not reaction, is the purpose of this channel. To understand where we are, we need to understand how long these cycles usually take. Economic history does not move in quarters. It moves in phases measured in years, sometimes decades. When historians map periods of financial divergence, where asset prices rise faster than broad economic well-being, a consistent timeline emerges. Not exact, but constrained. The full cycle, from initial liquidity expansion to final repricing or reset, has historically taken 10 to 20 years. Rarely shorter, almost never faster. This is important because it explains why early stages feel comfortable and late stages feel confusing rather than catastrophic. Let us now slow this down even further and walk through the stages again, this time with behavioral markers. This stage begins with disruption, a financial crisis, a war, a systemic shock. Authorities respond by expanding liquidity to prevent collapse. Interest rates fall, credit becomes available, balance sheets expand. This phase feels constructive. Markets stabilize. Confidence returns. Most people remember this stage positively. Liquidity does not disperse evenly. It flows toward entities already connected to capital markets. Public equities rise. Real estate appreciates. Private assets revalue. This is when wealth gaps begin to widen, not because of malice, but because of access. Households without assets experience little immediate benefit. Those with assets see valuation gains. At this stage, the economy appears to be healing, but the healing is asymmetrical. This is the most misunderstood phase. Consumption continues, but increasingly through credit. Savings rates decline. Wage growth fails to match asset appreciation. Inflation becomes uneven, felt more strongly in essentials. Markets, however, remain supported by liquidity and concentration. This is where the phrase, "the economy feels broken," emerges. Not because growth is absent, but because participation is narrowing. This phase can last longer than expected. It often overlaps with optimistic narratives. Eventually, limits appear. Debt service becomes restrictive. Credit conditions tighten. Marginal borrowers struggle. Economic momentum slows despite elevated asset prices. This is when volatility returns, not necessarily crashes, but instability. Narratives shift from confidence to confusion. The system resolves its imbalances, sometimes through inflation, sometimes through asset repricing, sometimes through policy restructuring. History shows this phase is unavoidable, but unpredictable in form. Now, these stages are not moral judgments. They are mechanical outcomes. They result from how modern economies allocate capital over time. And every major financial system we've studied eventually encounters them. Let's examine another historical case. Britain in the late 1800s. During the height of the Industrial Revolution, capital flowed rapidly into infrastructure, railways, and global trade networks. Equity values rose. Empire-wide wealth expanded. But wages lagged. Urban living costs increased. Household debt rose. This created a prolonged divergence. For decades, Britain appeared wealthy on paper. In reality, the benefits were unevenly distributed. The eventual adjustment did not arrive as a single event. It unfolded slowly, through declining returns, global competition, and social restructuring. Once again, markets did not signal danger. They signaled concentration. Now consider the United States after 2008. Liquidity expansion was immediate. Asset repricing followed. Equities recovered far faster than wages. Housing rebounded selectively. For years, this divergence was described as recovery. But recovery for whom? The structure followed the same sequence. Liquidity, asset absorption, economic lag. The present moment fits cleanly into this historical framework, not as an anomaly, but as a continuation. This is why emotional language is unnecessary. The pattern does not require panic to function. It simply unfolds. At this point, it is important to pause and emphasize something. History does not say that markets must crash. It says that constraints eventually assert themselves, sometimes gently, sometimes abruptly, but always structurally. Now, if this framework is resonating so far, this is a good moment to pause and press the like button and subscribe to The Finance Historian. This channel exists to slow these conversations down, so understanding replaces anxiety. In the next part, we will move from structure to evidence. We will examine multiple case studies across different eras that followed this exact sequence, not selectively, not narratively, but mechanically. Because when the same structure appears under different technologies, currencies, and political systems, it stops being coincidence and starts becoming signal. To test whether a pattern is real, historians look for repetition under different conditions, different governments, different monetary systems, different technologies. If the sequence remains consistent, the mechanism is structural. So now, we move to case studies. Not anecdotes, not dramatic moments, but long arcs where markets advanced while the lived economy lagged, and where the divergence persisted quietly before resolving. We begin with the Dutch Republic in the 17th century. At the time, the Netherlands was the most financially advanced economy in the world. It had deep capital markets, sophisticated banking, global trade dominance. Asset prices, particularly shares in trading companies, rose steadily. The famous Dutch East India Company became one of the first truly global corporations. To outside observers, this looked like prosperity. But beneath it, wages stagnated relative to asset prices. Urban living costs increased. Household debt expanded. The economy did not collapse suddenly. Instead, returns slowly diminished. Capital concentrated further. Trade advantages narrowed. The divergence resolved through declining growth and gradual loss of dominance, not panic. The structure held. Now move forward to France in the late 18th century, prior to the Revolution. French financial markets were strong. Government debt instruments traded actively. Land values rose. At the same time, food prices climbed. Wages lagged. Household budgets strained. The divergence between asset holders and wage earners widened. Once again, the system did not fail immediately. The strain accumulated. What followed was not caused by markets alone, but the imbalance made the system fragile. This distinction matters. Markets did not cause the outcome. They reflected the concentration that preceded it. Now consider the United States during the Gilded Age. Industrial capital expanded rapidly. Railroads, steel, and finance created immense wealth. Stock markets advanced. Fortunes were built. But labor conditions were harsh. Wages volatile. Living costs uneven. The divergence lasted decades. The eventual adjustment came through regulation, labor reform, and structural change, not a single market event. Again, the cycle held. Now let's examine a more modern case. The United States in the late 1990s. Equities surged. Technology valuations expanded. Markets appeared to be pricing a new era. But wage growth was modest. Household debt increased. Consumption relied increasingly on asset appreciation. The divergence resolved through repricing. Not immediately catastrophic, but corrective. The pattern repeated. What unites these cases is not ideology or policy. It is sequence. Liquidity flows toward assets first. Economic benefits diffuse slowly. Constraints eventually appear. This is why the phrase, "the market is not the economy," exists. It is not dismissive. It is descriptive. Markets measure capital returns. Economies measure lived conditions. They overlap, but they are not the same. At this point, a crucial insight emerges. The longer the divergence persists, the more normalized it feels. People adapt. Expectations adjust. High prices become the new normal. Debt becomes routine. This adaptation masks the structural pressure building underneath. History shows that the most dangerous assumption is not optimism, but permanence. Now, return again to the present. High market capitalization is concentrated in fewer firms than at any point in modern history. Household debt is elevated. Cost of living pressures remain sticky. This is not unique. It is familiar. But familiarity does not mean safety. It means we know the structure. And structure tells us what constraints tend to follow. Not timing, not magnitude, but direction. In the next part, we will map today's conditions directly onto the historical framework. Not with opinion, with data behavior, institutional movement, household balance sheets, market concentration. This is where abstraction ends and alignment begins. Because once the present is placed cleanly within the cycle, confusion gives way to clarity. Now we move from history into the present. We are no longer studying the past to tell a story. We are studying the past to recognize a structure that is repeating and to map today's behavior onto that structure. The question is simple. Which stage are we in? To answer, we look at measurable behavior, not opinions, not speculation, but observable movement. We begin with the most visible marker, market concentration. A small number of companies now account for a very large portion of equity market capitalization. This is not inherently bad. It is, however, structurally significant. Because concentration means that market performance is driven by a narrow slice of the economy, which explains why the market can rise while most people feel left behind. A few firms benefit from scale, network effects, and low marginal costs. They generate outsized returns. The broader economy, especially small businesses and wage earners, does not share those returns. This is the asset repricing stage, the second stage in our cycle. Capital is being reallocated to where it can grow most efficiently, but the benefits do not diffuse. Next, we look at household debt and consumption patterns. Consumer spending remains elevated, but the structure of that spending has shifted. More spending is financed. More spending is delayed. More spending is dependent on credit availability. This is the economic lag stage, stage 3. People are still buying, but the means of buying have changed. Savings rates decline. Debt service rises. Wage growth fails to keep pace with living costs. When the average household begins to rely on credit to maintain the same lifestyle, it is not a sign of strength. It is a sign of constraint. Not a crisis, a constraint. Now consider corporate behavior. Large firms are increasingly using profits to buy back stock, reduce debt, or increase dividends. They are not necessarily investing in new productive capacity at the same pace. This is important. When corporations prioritize financial returns over physical expansion, it strengthens markets. But it does not necessarily improve the lived economy. It does not create broad-based wage growth. It creates capital efficiency, not economic participation. This is the same behavior seen in prior cycles. The financial system rewards capital that is already established. It does not reward labor. Next, we observe institutional positioning. Pension funds, sovereign wealth funds, and large asset managers are increasingly positioned in equities and private markets. This is not new, but what is notable is the speed and scale. Capital is flowing into the same asset classes at the same time. This is the quiet institutional behavior that rarely makes headlines. It is not loud. It is not dramatic. It is simply the system adjusting. When institutions behave this way, they are not betting. They are allocating. Allocation is not emotional. It is structural. This is why the market can be high while the economy feels broken. The system is functioning exactly as designed. But the design does not prioritize broad participation. It prioritizes capital preservation and growth. Now, we turn to a final marker, policy response. Monetary policy has been supportive for years. Interest rates have been historically low for long periods. This is part of the liquidity expansion stage. Even when rates rise, they rise from a low base. And the system remains reliant on liquidity. When the system becomes dependent on liquidity, it becomes sensitive to any sign of tightening. Not because tightening causes collapse, but because tightening reveals constraints. This is why the market can remain strong until it doesn't. Because the system is built to be stable under liquidity, but not under constraint. So where does this place us in the cycle? If we map the present-day data onto the framework, we see a clear alignment. Stage 1 is complete. Liquidity expansion has already occurred. Stage 2 is advanced. Asset repricing and concentration are highly developed. Stage 3 is ongoing. Economic lag is visible through wage stagnation, debt reliance, and affordability pressure. This is not a hypothesis. It is a structural mapping. The pattern is not perfect, but it is consistent. Which brings us to the next question: what logically follows? Not as prediction, but as structural consequence. That is the subject of the next part. Because once the system reaches this stage, certain constraints become unavoidable. Not because the system is failing, but because it is reaching the limits of its current design. Now we address the most important part of this analysis. Not what the market might do, but what systemically follows from the structure we have mapped. This is not prophecy. It is arithmetic. The cycle we are discussing is driven by constraints, and constraints have consequences. When asset prices rise faster than incomes, a few outcomes become mathematically likely. Not guaranteed, but likely, because the system is forced to adjust. We will examine these consequences in the language of trade-offs, not drama. Consequence 1. The rising cost of capital. As asset prices rise, capital becomes more expensive for new entrants. This affects small businesses more than large firms. Large firms can borrow cheaply and buy competitors. Small firms cannot. This increases concentration further. The system becomes less competitive, and the economy becomes less resilient. This is not a political judgment. It is a structural outcome of capital concentration. Consequence 2. Household leverage becomes a substitute for wage growth. When wages stagnate, households compensate by borrowing. This keeps consumption stable for a time, but it also increases vulnerability. The system becomes more sensitive to interest rate changes and to employment shocks. This is a classic sign of stage 3. Economic lag. The economy looks stable, but the underlying support is credit. Credit is not infinite, and it is not evenly distributed. This is why affordability pressures remain even when markets are high. Consequence 3. Inflation becomes uneven. When the system is in stage 3, inflation is not uniform. It shows up in essentials first: food, housing, energy. At the same time, asset prices rise in parallel. This creates a dual reality. A household can feel squeezed, while the stock market appears confident. This duality is a structural feature of the cycle. It is not an anomaly. It is the system behaving predictably. Consequence 4. The market becomes more sensitive to policy shifts. In a liquidity-dependent system, policy changes matter more than they should. Not because policy is weak, but because the system has become reliant on it. When the central bank adjusts rates, the market reacts. Not just because rates affect borrowing costs, but because rates signal the system's tolerance for leverage. This is why volatility can return suddenly. Not because something bad happened, but because the system is testing its limits. Consequence 5. The disconnect between markets and the real economy widens. This is the most relevant consequence for everyday viewers. As markets rise, the economy can continue to feel broken because the benefits are concentrated, because capital is concentrated, because income growth is slow, because credit is being used to maintain consumption. This is the structural explanation for the paradox. Not opinion, not hype, structure. Now, it is important to understand that these consequences do not occur all at once. They unfold gradually, often over several years. This is why the public narrative remains confusing, because the system is not collapsing. It is adjusting, but adjustment can be uncomfortable. The discomfort is not a sign of failure. It is a sign that the system is reaching the limits of its current stage. At this point, the most common question is, if this is happening, what comes next? To answer, we return to history. In past cycles, the resolution stage has taken one of 3 forms. Not predictions, not certainty, just historical possibilities. Resolution path 1. Inflationary adjustment. The system resolves by reducing the real value of debt. Inflation rises. Real wages may fall. Asset prices may continue rising. This is a repricing of the system. It reduces the burden of debt, but it also reduces purchasing power. Resolution path 2. Deflationary adjustment. The system resolves through credit contraction. Debt is reduced. Asset prices fall. This is painful, but it restores balance. Resolution path 3. Structural policy shift. The system resolves through regulation, taxation, or redistribution. Not necessarily political, but structural. This path often occurs when the divergence becomes politically or socially untenable. The key point is that the system cannot remain in stage 3 forever. It must move. And the movement is not random. It is constrained. Now, we are not here to advise. We are here to explain. Because understanding the structure allows individuals to prepare, adapt, and remain aware. Not to panic, not to speculate, just to see the pattern. In the next part, we will examine what this shift means for individuals. Not in the sense of investment advice, but in the sense of how the system will change incentives, risks, and behavior. Because the system does not care about your story, it cares about constraints. We have now walked through the full cycle, from liquidity expansion, to asset repricing, to economic lag, to constraints, and toward eventual adjustment. We have examined history. We have mapped the present. We have identified the structure. Now we conclude by explaining what this means for individuals, not as financial advice, but as practical understanding. Because the most valuable outcome of history is not fear. It is clarity. This is the central truth. The stock market reflects capital. The real economy reflects labor and consumption. When capital concentrates, markets rise. When wages lag, households feel pressure. These two can coexist for long periods. That is the disconnect. It is not a bug. It is a feature of modern financial systems. The market is not lying. It is simply measuring something different. The system is already in stage 3. This means the most probable next step is constraint convergence. Not necessarily collapse, but increasing friction. For households, for small businesses, for credit markets, the system becomes more sensitive. Not because it is weak, but because it is stretched. This is why we see elevated debt levels, stagnant wages, rising essential costs, market highs all at once. These are not separate phenomena. They are different symptoms of the same structural stage. When the system is in this stage, incentives shift. Capital seeks safety. Institutions prefer certainty. This means more capital flows into large, dominant firms. Smaller firms struggle for financing. Labor's bargaining power weakens. Debt becomes the tool of consumption. These incentives shape the economy quietly. They do not announce themselves, but they become visible in data. There is no single answer, but there are structural realities that matter. First, if you do not own assets, the market's rise will feel distant. It will feel like a story you watch from the outside. This is not an emotional failure. It is a structural outcome of concentration. Second, if you are living on credit, you are living on a system that becomes more fragile as rates rise. Credit is not always bad, but it is sensitive to constraint. Third, if you are employed, your income may not keep pace with asset-driven inflation. This creates a persistent pressure that can feel personal, but it is systemic. Fourth, if you own assets, you may be benefiting from the system's concentration. This is also structural. It does not make the outcome moral. It simply makes it real. History does not show that markets always crash. It shows that systems eventually adjust. The adjustment is not always dramatic, but it is always structural. And the earlier you recognize the stage, the clearer the choices become. Not to guess the future, but to understand the present. Why does Wall Street keep hitting highs while the economy feels broken? Because the market is a capital distribution mechanism, and the real economy is a labor and consumption mechanism. When liquidity flows, asset prices rise first. When income lags, the real economy feels the strain. This is a repeatable historical cycle. It is not political. It is mathematical. It is structural, and it is unfolding now. The pattern is already visible. It is already measurable. It is already happening. If this analysis helped you see the system more clearly, press the like button and subscribe to The Finance Historian. And tell me where you're watching from. Because the most important part of history is not the past. It is what it teaches us about the present. The pattern is not a rumor. It is not a prediction. It is a quiet, unfolding structure. And it will continue to shape the world, whether we notice it or not.